Welcome everybody. Everybody's joining. Got Christine, Dave, Andrew. Is this your first time attending?
It is.
Welcome, brother. How you doing, man?
Good. How are you?
Awesome. So thanks for your first time attendance here. This is we do this every month, and we have real-time Q&A if people want. So Andrew, I appreciate you hopping on here, buddy. You don't have to be unmuted, but I just wanted to say hi, man. Thanks for joining here. And we've got Shelly and her curly Q hair looking fabulous. Mr. Braun, welcome back. David's always nice enough to play ball with us live here. All right, let's hop into it. So it's just Colin and I today, along with Shelly, and Brittany J is somewhere in here. I can't find her. Okay, let's hop into it. Colin, I think an interesting topic is every year, I believe on average, I think I'm saying this right, every year in the markets, on average, there is a 14% drop. This year was no exception, right? We just go back a few months ago to when your boy Trump was on the microphone talking about tariffs, and we remember how much the market dropped by. Now here we are at the end of the year. All of that has smoothed itself over. We haven't had an amazing year so far. What are your thoughts on that, right? Like, what a lot of investors don't realize is that during the year, the market usually drops by 14% or more, but I think that's the average number. What are your thoughts?
Yeah, it's a great topic. I had a great conversation yesterday, the day before, with a client talking about someone he knows about this. So I'll circle back to that in just a second. But we always try to stress that like price is just a snapshot of what someone would buy for it in that particular moment, right? And that's true not of just public markets when we're talking about public companies, but literally anything, like the chair that I'm sitting on, the building that I'm sitting in, the car I drove here in, etc. It's just a snapshot of what someone would, or the market, would be willing to pay for it at that moment. There is a massive distinction in short-term price fluctuations and investing, right? When we are investing, you are owning assets, you are owning value creation, and that naturally, right, for good reasons, bad reasons, or in between, is going to have its economic cycles, right? Whether it be a more favorable price that you could sell it for at the moment, a more favorable price that you could buy it at the moment, or the opposite end of that, right? You might not want to sell, you might not want to buy, etc. It is part of getting the long-term returns that many of you are either have witnessed or realized with us for many years, or you're starting to see just over the short couple of years that you've been working with us. Part of the price to admission of getting the long-term compounded 8, 10, 12, 15% returns that you guys have seen is sitting through the cyclical price movements that even intra-year during good years, like the one that we're currently having, can be down 15, 20, 25%, right? So the average drawdown, to your point, being roughly 14% per year, that is price of admission to getting the long-term rates of return that you're going to get in the public markets. And to be specific, owning businesses in the public markets. And I know we're going to circle back to that topic here in a little bit.
Yeah, exactly. I mean, price fluctuation, you have to think about what price fluctuation is at its core, just what somebody's willing to pay at that given time, which can be impacted by a whole host of reasons. I mean, literally the most random of reasons. I'll prove this point. I heard a fascinating case study during COVID. So the very mechanism that we are on right now, called Zoom, I heard this story about another stock that went up tremendously during COVID because its ticker symbol looked like Zoom's ticker symbol. That's crazy, right? Like that would be like, think about what that is. The financial markets in the securities world have gotten so efficient that you could mistakenly buy the wrong asset and not know it. If you're not doing any due diligence and you're like, oh, that looks like the ticker symbol Zoom, I'm just going to buy that. Imagine you did that with real estate, right? You went in to move in on the day that you purchased the property. You're like, no, I'm supposed to be in the property across the street. It's like, no, you bought this house for $2 million, right? This is how ridiculous price fluctuations can be at times. But as Warren Buffett said, and maybe it wasn't Warren Buffett, maybe it was somebody else, it's in the short term, the market is a voting machine. In the long term, it's a weighing machine. Very, 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 very different. Like short-term popularity contest versus long-term quality weight is very different. To illustrate this point, Colin and I share, and Joel share a lot of different graphs throughout the month to each other, and then we bring some of those up on the roundtables here. So let me bring this in. I think this would be valuable. Colin shared this with me. I thought it was great. Give me 1 second, and here we go. Okay. Colin, walk us through this chart. I thought it was outstanding. If you guys can see that here.
Yes, yes, yes. This is showing, obviously, so from left to right, right? The far left bar chart, right, is showing causes of deaths in the United States in 2023. And then from there, right, we're going to be apolitical about this, whether it's the New York Times, Washington Post, or Fox News. It's showing the relative coverage of the causes of death on their media platforms. As you can kind of quickly see, there's a massive asymmetry in like what's causing people to die versus what they're covering on the news. And we could speculate until we're blue in the face, I guess, as to why that might be. You guys are smart people. You could probably fill in the blanks there. But I just, if heart disease and cancer got the coverage that the other stuff that you see in like the light and dark green, right, are getting across the news coverages, maybe it would be a much healthier country, just due to awareness of it.
Yeah, exactly. I mean, and how this relates to investing is that same skewness, in my view, happens in the investment world, right? You have to remember that media companies, right, wrong, or indifferent, their sole objective is to get your eyeballs to pay attention to what they are saying. Human beings, study after study shows that human beings have an enormous asymmetry in attention to negative stimulus. 100%. If you think about this from a historical standpoint, why? Because if there's something rustling in the bushes, right, you are supposed to be more scared of that than the opportunities of the berries on the left-hand side of the trail, right? Because if you don't pay attention to the rustling in the bushes when we were cavemen and women, you might have died because there's a saber-toothed tiger sitting behind those bushes. So your brain is specifically engineered to pay attention to threats way more than it pays attention to opportunities. Now, the hard part in today's world is that, well, we have to take advantage of opportunities today so that we are protected against the threats in the future. If you do not grow your money, right, and you are going into retirement and you're 70 years old, going into 80, et cetera, and on, right? If your money has not been growing, you will not be able likely to pay for long-term care cost. That is a threat that exists for all of us in the future. If we don't invest our capital and inflation is degrading the purchasing power of that capital at 3 to 10% per year, whatever your personal inflation is, you will very likely go broke multiple decades, if not a decade from today. So yes, investing, is it difficult? Of course it is. But you know what else is difficult? When you're broke in your 80s. My grandmother wouldn't mind me sharing this. She is flat broke in her 80s. And I can tell you it is not a pleasant experience. So as a leader, you have to choose your pain. You either choose the pain of the discipline or the pain of the regret, as they say. Right? There is no risk-free path. There's no path that's just all sunshine and rainbows. It does not work like that. Investing is no exception. So, Colin, I love that graph that you shared. Like the amount of distortion that the media displays that differs from what the actual reality is unbelievable, off the charts. Anything else to say on that, bud?
Yeah, one last comment, because I want to circle back to, I mentioned I had a conversation with a client the other day. Right? He told me somebody that he knows pulled out the money in April, pulled out their own investment money in April during like the tariff scare, right? And haven't gotten back in. Now, to this client's credit, really, really well behaved, well disciplined, like fantastic wealth builder, right? Good leader for him and his family. Obviously, not somebody that behaved this way. But the reason I want to circle back to it is we hear stories of like that quite often, and I would say our clients, our investors, have actually, in large part, done a fantastic job of avoiding those types of mistakes. But something that I do think happens quite often, because again, it's on the other end of the spectrum, but kind of the other side of the same sheet of paper. That like hand in the cookie jar, uh, just the yearning for, hey, Bitcoin has gone up, right? Should I behave this way, right? Or XYZ company is having a fantastic quarter or a fantastic year. Should we invest in that, right? Like chasing the hot the hot topic, right? The media frenzy could also be detrimental in that regard as well. So it's not just when tariffs are causing a drag on the market, the price of the market temporarily, like in April, but also, when Bitcoin's going up or when Nvidia's on fire or, whatever the next flavor of the day will be. There's a lot of danger in chasing the hot return as well, right? So we have to be careful on both ends of the spectrum, not to panic and overreact to negative news, but also not to get caught up in gold going up by 100% over 2 years and thinking we need to buy a bunch of gold now, right? So
Yep.
yeah, it's like you mentioned, Wes, man, it is tough. It is not easy, right? But that's why wealth building's hard. There's not a lot of wealthy people because of it.
Yep, 100%. Well, as we say here, like wealth building actually takes work. So wealth takes work. It's not just this catching lightning in a bottle and hoping I buy something low and sell it for a super high price. While that sounds really good in theory, right? I literally do not know a single person that's ever done that. And if they caught lightning in a bottle once, which again I don't know, there's basically no way they're going to catch lightning in a bottle twice.
It,
So now if we look at how this all blends together, Colin, you sent another great chart. Let me share it here. And I don't know where this chart came from. We got to get the source of this, but phenomenal chart saying staying the course worked in parentheses again, right? So the world did not fall apart after the tariffs. Again, I'm like Colin. I do not have a dog in this fight for politics. Love Trump, hate Trump, doesn't matter to me, right? What matters is capitalism and the markets and whether or not your companies that you're investing in are working for you to help lead you and your family. It worked again, meaning that we went through the turbulence earlier in this year, also meaning this will happen again. Turbulence will happen again for sure. So we always want to stick to the fundamentals. We want to stay humble even during highly profitable years, because just remember, the next piece of turbulence will be around the corner. We can expect it. We just cannot predict it, as they say. Colin, why don't you explain this chart, bud?
Yeah, this is fantastic. So it's about about a month and a half old now. So obviously the percentage returns are slightly different, right? But the blue drawdowns represent where the bottom of each individual index, bottom out back in April, right? So at the far left, we see the S&P 500. It was down 15% at one point in time this year, but as of the end of October, right, year to date return, it was up almost 18%, right? And then just commensurately walk through it based on the index that it's representing, right? NASDAQ down 18.5% year to date, or at least as of October 27th, up a little over 23%, so on and so forth, right? So to get the 17, 18, 20, 23% rate of return, you had to sit through the drawdown. You had to sit through the 15% negative turbulence or the 18.5% downward turbulence, right? That's the price to admission. That's what's called being an investor. I've rarely gotten phone calls, but have talked to a number of clients this week. There has been a bit of a pullback in the markets, right? But we're still only like 3% off of all-time highs. We are still, way to the plus, not just this year, but if you zoom out over the past handful of years, your accounts have done extremely, extremely well by staying the course, staying invested, because again, we are not investing for short-term price fluctuation or short-term turbulence, either, in either direction. We own fantastic businesses that create value and capture a portion of it to reinvest in the company, distribute to investors, right? And continue to serve the marketplace. It's a huge distinction. I know it might sound elementary, right? But there's a massive distinction in owning price fluctuation versus owning value creation.
Yeah, I mean, and this is why, and I'm not going to name certain names of assets right now, but there's always going to be sexy, attractive assets. For those of you who haven't heard this before, right? There was something called the tulip bubble, generations ago, where a single tulip, adjusted for today's dollars, sold for $150,000. Right? That's the rough approximation. Now, and as many of you have probably heard me say, you might think, well, that's because humans were not so smart generations ago. Well, as we've said on here before, Dave, if you don't mind me picking on you, what did that banana that was duct taped to a wall recently sell for at some sort of art show thing?
Oh,
And
yeah.
yes, for people wondering, it was an actual banana
Mhm.
duct taped with actual duct tape to a wall.
Yeah, wasn't that like a million or something like that?
I think it was
Crazy.
$6 million.
6 million. Okay.
That happened, I think, within the last 12 months. So that would be an example of a speculative asset. Now, if you want to go out and gamble with bananas, go for it. I highly doubt you're going to get $6 million for it. I think that was lightning in a bottle. That's probably never going to happen again with a banana, but it will happen with something else. Now, the funny thing is, I had a mentor tell me years ago, he said, you can't tell right and wrong by counting heads. The problem becomes when, oh, now a bunch of people are selling bananas for millions of dollars. I could also do that too, right? But again, that's where I'd ask you of like, hey, number one, does your gut tell you, right, that feels like the right thing? Does that maybe feel like a trend? Regardless of whether or not how many people around you are telling you that this is the greatest thing that's ever been invented. Like you have to come down to the core and say, okay, if I'm going to be investing, not gambling, if I'm going to be investing, what would I think about actually investing in things that produce value that are very likely to continue in the future? So the example I always use is Apple Computer. I love Apple's products, right? Because they create high quality products that just deliver. The stuff just works and it's beautiful, right? So I think that they have a very strong likelihood of doing that again tomorrow and the next day and the next day and the year after that, etc. So I think that for me personally is a stronger argument than buying a banana that's duct taped to a wall. Call me crazy, right? But I want all of us to think in that way, the value production of an asset. Now, I am not saying that capitalism is the most perfect system in the world, but I do think that it solves for a lot. And this graph helps us walk through that. Let me share this with you. Colin sent this over. I thought it was outstanding. Let's see this. All right, Colin, maybe if you don't mind, walk us through this chart, bud.
Oh boy. Yep. So just
Fascinating chart.
yeah, unbelievable, right? Gross domestic product of North and South Korea, right? So two countries separated by miles, right? So right, same geography essentially on Earth, right? So you see a massive study, a 200-year tracking of gross domestic product between North Korea and South Korea. There's a J curve in one of the countries and essentially a non-starter in the other, right? Yeah, I guess it bleeds over into politics, but this story has been written in fortunately, or I guess unfortunately, tried to have been rewritten many of times in many different locations, many different countries, many different economies for as long as humans have been around, right? Again, we definitely have our bumps and bruises, we have our blemishes here with our capitalist system, but South Korea exhibits the rising of the bottom, right? Which is super important in my estimation, right? The least wealthy people in their society, right, get the benefit of their gross domestic product rising over, again, the last, well, in this instance, 70, 75 years, right? Unfortunately, for the people that are born in North Korea, they do not have the same system to participate in, and that's the result, right? This is not a feelings or emotions conversation. This is just the actual raw data or the raw outcomes of the two economic systems stacked on top of each other. Right? So just a fascinating visual of polar opposite economic policies in practice.
Yeah, absolutely. And as they say, oftentimes we don't have to be taught, we just have to be reminded. Um, really getting this stuff into your bones is really helpful, which was I'm so, if you know what, guys, don't mind me saying this, I'm proud of all of you guys, including all of us who show up every single month to talk about this, to remind ourselves of what we're actually invested in. Because it's easy and kind of boring to talk about it now and during good times, but when you have the reps in to where it's muscle memory, so that when there is a storm that hits the shore, you can rely on your instincts because you've practiced that shot so many times, right? Now, with that being said, there was an interesting topic. I always like to bring up topics that happen with actual clients throughout the month so we all can learn from it. And there was one of our phenomenal clients here, absolute great guy. He's actually on this call right now. Brought up the idea of taxes, and taxes is just one of those curse words that as soon as you bring it up, right, it's like it's an atomic bomb.
Mhm.
Now, let's take a deep dive into this. This can be so misleading because when you get your tax bill, it's given to you in a vacuum, right? Like you just see this number, right? And then it might as well just be like blinking red, dripping blood from it, right? You just see that number by itself. What you don't see is the mountain of profit that you made that makes you pay that tax, right? Now small proportionally to the profit you've made, but because they don't show that right next to it, right? And your accountant can sometimes make comments of like, "Ooh, that's a lot of tax," right? Like that doesn't help. So it's kind of like sticking the knife in and twisting it. It's helpful to know that when you're making profit in certain registrations of accounts, yeah, you're going to pay tax on it. Now, it's obvious when I say this, but it's like I'd rather all of us keep 80% of a lot of profit than 100% of no profit. Now, this sounds so simple and juvenile when I break it down this way, but I promise you, in the real world, it feels and hits a lot differently, right? It's like if you pay $100,000 in tax, but you made whatever, $1 million or whatever it is, 800,000 in profit, right? It's hard for the brain to connect those two because again, we have disproportional feelings about negative stimulus. So with that being said, I'm saying this as a warning because we're now going into like, the final part of the year where depending on how you communicate with your CPAs, they might be throwing out some different like tax strategies, etc. Just be careful of not going down the wrong road because you might be trying to solve for that pain. And the reality is it might not have to be solved at all. If you made a bunch of money, you paid a little bit of tax on it. Okay, great. Versus being sold on this, like, honestly, I think there's a lot of schemes out there. I don't want to call them scams because they might have like some truth to it, but they're kind of more schemy, right? So what you really want to be paying attention to is what are the net numbers? The net numbers, right? So what's your top line minus your expenses, and that net is what we want to pay attention to, right? Does that make sense? David, maybe you don't mind, man, can you unmute? Like, what is your thought on that from a client's perspective, from an investor's perspective? What are your thoughts on that?
Why don't you go ahead and repeat what you said? Thoughts on
Yeah, so how easy is it to be susceptible to falling into the trap of like, oh my gosh, I got to pay this tax number, and that's what I'm focused on, and I lost sight of like, oh, what profit did I make to get to that tax number? Does that make sense?
Yeah. Yeah. I mean, like you said, anytime you have a number in isolation,
Yeah.
it can skew you because, 10 cents, you say the number 10 cents, well, that sounds like nothing, but 100 years ago, 10 cents was a lot of money. So you have to put the money in context. It's not about the absolute value, it's about the context you have to build around it. So yeah, like you said, if you're paying a lot of taxes, but you're making a lot of money, that's a good thing. That's not nothing to worry about. Of course, you want to limit your taxes. You want to be reasonable, but you
Yes.
don't want to do that at the expense of all of that profit.
And man, you're hitting on a phenomenal human bias. I'm an enormous fan of behavioral economics and behavioral finance. So I'm going to give you guys an example that probably some of you have heard before, but it's outstanding. So David, you're hitting on a point of what are you relating it to, right? So as an example, and bear with me here, I know we've talked about this before, but bear with me. Pretend you're at a Mercedes dealership, you're about to buy a car for whatever, 80 grand, and David Braun, it's you at the checkout counter, right? Pretending there's a checkout counter at Mercedes, right? And I say, David, hey man, real quick. I call you up, hey man, I heard that you're about to buy this Mercedes for 80 grand. Don't do it. He said, okay, why? So because I found the same exact Mercedes. It's a mile and a half down the road. It's $10 cheaper, right? So David, play along if you don't mind, or tell me the truth. Would you stop the sales process and would you drive that mile and a half down the road to save the $10?
No, of course not.
Right. And do you think most other people would?
They would not.
Right. Now, you're saying we're instead of buying a Mercedes, we're now buying Colgate toothpaste, right? And I hear that you're about to buy 3 tubes of toothpaste in those 3 packs at Target. And I hear this, and because I love you so much, I call you, say, David, don't you dare make this mistake. You're about to buy that toothpaste, 3 tubes for $20. They have it down the street at the next Target for $10. Do you feel your gut telling you that you would not buy it at that Target and you would buy it at the other Target?
Well, sure, because the that's like a huge savings, but percentage
Proportionally.
wise and all that, right?
Exactly.
Yeah.
So it's the same $10, right? But because you're relating it, and I would do the same thing, by the way, right? Because we're relating the $10 to 80,000 of the Mercedes versus the same $10, but we're relating it to the 3 tubes of toothpaste, $20 versus 10, right? We would almost all of us at least would get the feeling that we want to go to the next Target. So David, to your point, spot on. The amount of times where we see a tax bill because you've made $1 million, right? And you got to pay a tax bill of a fraction of that. You're oftentimes relating it to your checking account. Oh my gosh, I got to pay this 100 grand or this 150 grand in tax. My checking account's only at 30. Holy smokes, right? Versus the $1 million that you made over here. I'm making all these numbers up, obviously. The $1 million that we made over here, which also, by the way, a lot of clients I've talked to recently just know that, like, oftentimes you can have the investment accounts sort of be self-funding even for the tax bill. So let's say you have a trust account, taxable trust account, right? And you have taxes all in dividends, et cetera. Well, you don't have to pay the tax from your checking account or your savings. You could just have the taxes be paid from the investment account, if that makes sense. Like it can cover itself, in other words, like many, many times, right? So a lot of times people don't know those logistics. Colin, would you agree? Any comments on this whole conversation?
Yeah, I do have a comment that might be some helpful social proof. We hear parroted, basically by everyone, including the media, that California and New York have the highest taxes. They do, right? They also have the highest concentration of wealthy people in the country. So there's something to that, obviously, right? They understand that that beehive effect of Silicon Valley or that beehive effect of Manhattan, right? Being in the like literally the nucleus of whether it be finance or tech, right? Just to use those 2 examples, they can make more net money even after higher taxes. Right? It's apples to apples from a federal standpoint, but not from a state and local standpoint in those 2 places, right? They can pay roughly 50 or sometimes just upwards of 50% tax, but they still choose to do it because the net number is larger. Right, so just look at the social proof that absolutely exists in both of 2 of the highest tax concentration areas in the country, and you'll see that the net numbers are larger there, even factoring in higher taxes. Right, so I don't know about you guys. I would be much more worried about the net profit, right? What I can actually walk around with, fund my vacations, fund my lifestyle, do things for my family, as opposed to the tax percentage that gets applied on April 15th or whenever you file your taxes.
That was just Colin's roundabout way of saying that he voted for Mom Donnie, or he would
That's
have
right.
voted for Mom
That's
Donnie.
right. We were in New
New
York
City.
while that went down, Wes. You know, I had to
Yeah.
sneak off there for a second.
Yeah, I don't want to. I shouldn't have sparked that flame. So move on to the next topic. All right, let's look at this chart because I thought this was also outstanding. I want to dissect this a little bit so that again, all of us can understand what we're investing in and invested in. So let's, Colin, break down this chart first, if you don't mind. This is from the
Yes.
Wall Street Journal.
Yeah.
You know, housing prices
Yes.
versus
Yes.
S&P 500 stocks.
This one actually sparked a lot of social commentary from the nerds I follow on social media, and I would like to, maybe balance this conversation out, right? Because I think this doesn't necessarily give the full context, but it does, it does show the disproportion between the appreciation of the average home price in this country versus the S&P 500, right? And as you can see, over the past 50 years, right, the owning an index of large companies like the companies that are represented in the S&P 500 dramatically outperforms from a price perspective the average price of a single family home in the United States. I think there is a ton of value to a primary residence, but there's often this conflated portion of the conversation that says like, oh, it's a great investment. Well, that's always a relative conversation. And from a relative perspective, relative to the other options that you can invest in, your primary residence is not generally better than a quality portfolio of businesses, right? And we could kind of, maybe ramble as to why that often is. But I think this is a fantastic visual of the inflate, the appreciation of home prices versus appreciation of public companies. It's not exactly close, including the mania that we've seen over the past handful of years, right? Home prices have probably seen, I'm guessing here, so don't hold me to this, one of, if not the best 5-year period, right? In all of our lifetimes over the past handful of years, and you can kind of see that spike there, right? But again, back to like net numbers being very important, right? In most of your guys' lifetime, in all of our lifetimes, I should say, public companies have dramatically appreciated over and above the average home price.
Right. And now I totally agree with you, Colin, that I look at investing, let's say long-term wealth building assets. I kind of phrase it in my head as the triple crown of investments, which public companies, private businesses, and real estate. I love all three of those personally. They all have different return profiles. Now, quick caveat on private businesses. Just so I'm not a fan of investing in private businesses that I wouldn't have ownership, like actual like managerial control over. So for anybody listening, like I do not recommend investing in private companies that don't have, like, it's just private companies and venture capital, all that stuff. I would not recommend to the typical investor. But when you own and operate a private business, absolutely love that for a family, assuming it's a healthy business. Real estate, same deal. Now, that's not to say that all three of those have synonymous return profiles, right? Just think about it. Expecting your local neighborhood family residence to produce the same level of value as Apple Computer, as Walmart, as Netflix, as Microsoft, etc. That piece of real estate, it provides value in the sense that it provides shelter, which is unbelievable, but it can't innovate. It can't go and create more products. It can't increase its profit margins. It can't sell across the world, right? It would be unreasonable, in my view, right, to have that sole piece of real estate appreciate as much percentage-wise as a company that can go and serve billions of people. So I think if you think about it from that lens, right, it makes a lot of sense. Now, that's not to say don't have it. That's not to say that at all. It's just, what result are you trying to get versus what return are you trying to get? I always tell our investors, including myself, maximize your result. What is the result or results that you want for you and your family? Then we can get to the vehicles. Colin, any comments on that?
Yeah, I think to be fair, right? A lot of the return in real estate actually comes from the leverage. So your mortgage,
Yeah.
right? You don't have to actually fund it all up front. You get to borrow money to do that, right? So, that piece is important. Also, if you're not talking about your primary residence and you're talking about it as an investment property, that's a massive difference as well, right? Because then you actually see cash flow on a monthly basis with the rents, right? So to balance out the conversation, but I wish I remember the exact details of this, but I remember having this conversation with Dave. He bought his home in 1980, right, back in California, right? And we did the math one time, just having some fun in the office of if he would have taken that money and just put it in the Dow Jones, right? What his house is worth today versus what that investment portfolio would be worth today. It was so asymmetrical. It was like 32 times more in the Dow Jones than in the primary residence. And this is in one of, the hottest, best real estate markets, not just in the country, but in the world, right? I think there's a lot of anecdotal evidence that people like capture and kind of blast as fact because grandma bought her home for $50,000 and then sold it for $250,000 5 years later. And that sounds great, and it's certainly not bad, but relative to what she could have invested that money in, right? Something just as simple as the S&P 500, what that would have turned out to be over that 50-year period dwarfs the 250 that she sold her property for. And that's before we start talking about property taxes on an annual basis, maintenance, right? Additions to the homes, redoing the concrete work outside, et cetera, et cetera.
Yep. Yeah, 100%. I mean, very rarely does somebody actually do the math. To your point, Colin, they're just looking point to point. Grandma purchased for $1, she sold for $1 times 20. Oh, that was a great investment. But again, it gets back to relativity. Well, relative to what? And then also, they're definitely not doing the math on like the amount of money that she put into it, right? The amount of taxes she paid in it, all of those types of things. So all of those are very, very important, which is why it's so important to calibrate conversations we're just having out there casually with friends and family and letting that influence our investment decisions, right? Oftentimes the story is just not complete. It's just not. All right, so let me pull this up. I thought this was really interesting as well. We're gonna do a segment now that we are loosely calling Behind the Stock, because for selfish purposes, I like to explore nerdy data stuff. So it's always to remind us that what we are not investing in ticker symbols that are just jumping up and down on our iPhone screen. That's not what we're investing in, right? And if you're doing that every day, you should probably stop doing that every day, right? You got to remember that that what you're looking at on your iPhone screen represents enormous companies that are committed to producing massive value at fair profit margin for its stakeholders and shareholders. That's what you guys and we all are. Now, full disclaimer, this is not me recommending these companies. So for the compliance department out there, this is not a formal recommendation. It's to zoom in on some of the assets that we've invested in, et cetera, just from a business case study standpoint. Anyway, disclaimer aside, let's jump into it. I thought this was super fascinating. We are going to jump into the classic Coca-Cola company. So, in a lot of our funds we invest in, Coca-Cola exists. I think it's an outstanding company, just an incredible case study of human ingenuity, value production over the course of decades. So, Colin, I'm going to throw out a few high-level stats here. Really fascinating stuff. So, per Gemini, this is where I got all this information from, Coca-Cola every single day sells 2.2 billion servings of its products. That's insane. It's also important to realize that it's not just like the actual Coca-Cola drink, right? They have, I think it's hundreds of products underneath of it, right? Then we go to next slide.
25% of the world.
Exactly, right? 200 countries and territories.
Wow.
Unbelievable. So this real quick on this is why I generally talk about investing in American-based companies, it's not that I don't think that there's other markets over the world that are good. It's no, that a lot of American-based companies are selling goods and services all across the globe. So we get the benefit of the expansion into other territories, plus the benefit of, right, like high quality regulated accounting standards, right? Where we don't have to guess whether or not these numbers are right because the US has very high standards for audits, for accounting, et cetera, right? Then I want to look at, okay, what is its market dominance? Coca-Cola versus Pepsi versus the other options, right? Unbelievable. Also, I'm not saying that these other companies are bad companies, but Coca-Cola's dominance has been unbelievable to watch over time. Over 200 active brands, right? Including water, juice, coffee, and tea. And by the way, snack products as well, right? Unbelievable. So annual volume in terms of cases sold, 33.7 billion unit cases of its products sold globally. Unbelievable. Colin, let me pause there. What are your thoughts so far, buddy?
Yeah, it's actually hard to understand like
Yep.
the depth or the vastness of of how much that is, right? This is it's essentially a fourth of the people taking a sip of Coca-Cola each day, consuming a Coca-Cola product, not just America, right? Around the world, right? Unbelievable, unbelievable.
Yeah, I mean, think about this. Again, I got this from Gemini. So if we look at this, I thought this stat was unreal. 94% of the entire world's population recognizes the iconic red and white Coca-Cola logo.
Wes, we used to tell that story a lot of them of Coca-Cola, that is, right? Digging the wells in
Yep.
undeveloped countries that they knew were turning developed, just a matter of time, and then putting the Coca-Cola logo over top of it, right? This is the level of marketing this company can go to
Look at
when,
Jack right now.
yeah.
There you go, buddy.
Heck yeah, heck yeah.
Jack is a brand ambassador of Coca-Cola. I don't know if you guys know that. Check him out on Instagram.
Our senior Coca-Cola correspondent.
That's right, buddy.
Yeah, love it, love it. Yeah, I mean, yeah, super recognized brand. They they have a corner on their taste, right? The durability of a company like Coca-Cola is, essentially unmatched. I don't know how you get more durable than a company like Coke.
Well, to that point, right, and what Colin's referring to expand on that a little bit, is um, we read this data, this article a while ago, where in emerging markets and developing countries, where from my understanding, they don't even have a real currency yet, right, to exchange goods and services. But Coca-Cola would sponsor watering holes there, like wells. So where the people would go to get their water, right? Coca-Cola would go and sponsor and dig like a really nice well, et cetera, and then they put Coca-Cola branding above it so that they can indoctrinate, right, the religion of the Coca-Cola brand of like, oh, that brand is good, right? So that a decade from that point or whenever that happens, where that country escalates into capitalism, that they will automatically have good associations to the Coca-Cola brand. Unbelievable, right? This is the degree to which these companies are going to expand, to provide to expand their footprint. Now, why does that matter to you? Well, if we go and we look at the dividend structure over time, this is where the bridge of dollars, right, gets sent over to you as the investor. These are their dividends over the course of time, right? Going back, and now we could go back even further for decades. This is unbelievable, right? And just look at the trend of this. So they're able to increase the size and scope and the goods that they're selling to consumers, and that translates to the investors in dividends per share. Colin, what's your take?
Yeah, well, and I think it's important to point out in the last, well, this is basically a 10-year chart, the doubling of the dividend, right? 10 years, right? We are Nick Murray disciples. As many of you know, you receive Nick Murray's, commentary monthly. There is a massive benefit to keeping up with the cost of living by owning dividend producing companies, right? Because they're the ones selling the goods and services that are increasing in cost, right? So when we go to the gas pump or when we go to the grocery store to buy a product like Coca-Cola, right? If it costs them more to manufacture, um, export, et cetera, Coca-Cola, well, guess what? Their profits, ultimately see that, right? Therefore, they get to share those profits with the investor, and that's the like logical tracking of how the dividend payout will double over 10 years, right? Because as they increase the cost of the goods sold, right, their profits go up, so they can share more of it, on net numbers, right, with us as investors. Right, so I think that's an important detail to point out here. If you want an inflation buster, if you want to keep up with the cost of goods, I'm sorry, the cost of living, right? Own the goods and services that are increasing in cost, right? So don't just be vulnerable when you go to be a consumer. Be on the other side of the transaction. Be the owner, so that your cash flow can be commensurate with that, and in many cases outpace it.
Yep, exactly. And let me know, Colin, can you guys see that, right?
Yes.
On my screen. I'm splitting my
Yep.
screen. What happens is we have oftentimes as investors when they can make, sort of like let's say like dysfunctional decisions about their portfolio, it's a zooming problem, right? It's a perspective problem typically. Now, assuming you're invested in fundamentally sound, right, like assets, productive assets ideally, right? If you look at my screen here, it's a zooming situation. And what we're describing with Coca-Cola, and we've talked about Apple in the past, Amazon, et cetera. If we zoom out, right, and what we're talking about now is like, look below the surface, zoom out a little bit more. And I'm just drawing this in real time, so let me know if this lands. Below the surface of that investment is just an unbelievable mountain of value underneath. What do we say? Trillions of dollars of ounces. I'm sorry, trillions of ounces of Coca-Cola's liquid products being sold across the planet in a given year, right? The amount of employees they have, the amount of distribution that they have is off the charts. So we have to remind ourselves of that mass that sits under the water level that we're often just not going deep enough to see and understand. I mean, these companies are making so much dollars. It's almost it's so many dollars, almost impossible to comprehend the magnitude. Now, the example I always give is just imagine that we were driving around the neighborhood, right? Stacy comes over, we're hanging out, right? And say, hey, Stacy, I'm going to take you to my favorite restaurant down the street. And I also say, hey, Stacy, by the way, because I'm trying to impress her, I also own the restaurant, right? And as we're driving down the street, I say, hey, I own that taco shop over there. I own that sporting goods store over there, and I do that a few more times as we're driving to the restaurant. Now, Stacy would think I'm like King Midas. So if I say that 10 times on our way to the restaurant, Stacy would probably be like, oh my gosh, this guy is like one of the richest men on the planet, right? He's got 15 companies as we drive, but those are small businesses, right? The reality is all of us on this, right? We own ownership, like we own shares of the largest companies on the planet, hundreds of them, who will also, by the way, of those hundreds, many of those have hundreds of locations, as we've discussed before in the past. Costco has over 960 locations. They make $29.05 million per hour in 2024, right? But because we've made the financial markets so efficient, right, to where we reduce it to a phone screen, we don't relate it to what it actually is. So it's our job as coaches and educators to remind you and remind ourselves of what we're actually invested in. So we're gonna make this a theme of like going behind the stock, going behind the brand of these companies, so we can get more connected with understanding what we're actually invested in. So, Colin, that's my final word to wisdom, buddy. Any final things you would add to this conversation?
Just to put a ribbon on it, there is no safer bet in my estimation than owning a healthy chunk of America over a multi-decade retirement. Right? The time horizon is important, right? Multi-decades. If you aren't an owner, right, you will always be vulnerable as a consumer. So yeah, I hope that resonates. I hope that lands. And next time we get together, hopefully we'll have additional visuals, additional graphs, additional charts, additional data to continue to reinforce this. Wes said something that to me, it sounds so simple, but it's so profound that we oftentimes don't need taught, we need retaught. And that's the purpose of these roundtables, right? So thank you, as always, because we love teaching this. We hope it's valuable. We hope this stuff is resonating, but we also really believe it's that important as, not only an investor, right, but as the financial leaders of your families.
Yeah, thank you guys very much. And thank you for all of you for attending month after month. And a special thank you for all of you who have the guts to show up on video. I know that's tough. So thank you very much. We love you guys. If you guys have any questions or need us at any time, just we're one phone call away. All right, you guys have a great day.